Hi there, welcome back to another episode of Finance Titan. If you are new to the channel and enjoy everything finance, then don't forget to subscribe for more content just like this. And with that, let's get into today's episode. As with any disruptive technology, the laws regarding cryptocurrency are evolving, but one fact has been certain since at least 2014. Cryptocurrency profits are taxable. The basics of cryptocurrency taxation were outlined by the Internal Revenue Service in IRS Notice 2014-21. This notice defined virtual currencies for tax purposes as property, not foreign currency. Further, if used in a transaction, its worth is set at its fair market value in US dollars at the time of the transaction. The difference between its value when purchased and its value when spent is taxable at the capital gains rate. If sold or exchanged at a profit, that profit is taxable at the capital gains rate. If you sell cryptocurrency at a profit, you owe capital gains on that profit, just as you would on a share of stock. If you use cryptocurrency to buy goods or services, you owe taxes on the increased value between the price you paid for the crypto coin and its value at the time you spent it. If you accept cryptocurrency as payment for goods or services, you must report it as business income. If you are a cryptocurrency miner, your income gained from mining counts as business income. For U.S. tax purposes, a Bitcoin or Ether or any other cryptocurrency is valued at its equivalent in U.S. dollars at the time of the transaction. Understanding cryptocurrency and taxes. Back in 2019, the Internal Revenue Service mailed 10,000 educational letters to taxpayers it suspected owed the government tax payments for virtual currency transactions. Clearly, the days of anonymous cryptocurrency transactions are at an end. It is possible that the federal agency based its list of recipients on customer data acquired from cryptocurrency exchange Coinbase. Those who do not report income correctly can face penalties, interest, or even criminal prosecution, the IRS warned. The move to transparency. The first cryptocurrency, Bitcoin, was introduced in 2009 as a peer-to-peer cash system. It was designed to be easy to use, easy to store, and anonymous. Your virtual wallet and the Bitcoins in it were as untraceable as the contents of a numbered Swiss bank account. It wasn't long before governments observed a surge in money laundering using cryptocurrency. Tax authorities, too, were bound to take note that invisible wealth is difficult or impossible to tax. Today, most cryptocurrency transactions are transparent. Cryptocurrency exchanges impose anti-money laundering requirements on Bitcoin traders to avoid drawing the ire of regulators and tax officials. Regulators, central bankers, and federal judges all continue to have different opinions on whether cryptocurrency should be considered a currency or a commodity. Nevertheless, all seem to agree that the profits acquired through trading and using it should be taxed. So what does that mean for traders? At this point, cryptocurrency exchanges do not send their users a 1099 form to help with their taxes. However, blockchain-based apps are available to help cryptocurrency investors record their transaction data and track taxable events. How crypto is taxed, different scenarios. Remember those two key points from the IRS notice published in 2014. If cryptocurrency is used to purchase something, it is considered to be worth its fair market value in US dollars at the time of the transaction. If cryptocurrency is sold or exchanged at a profit, that profit is taxable at the capital gains rate. Purchasing cryptocurrency. Say you bought one Bitcoin for about $3,700 in early 2019. In late February 2022, that Bitcoin was worth $38,500. You used the Bitcoin to buy a 2022 BMW X1. Yes, these are real prices. Bitcoin is that volatile. However, there are tax implications for both the buyer and the seller in this transaction. The seller must report the transaction as gross income based on the fair market value in US dollars of a Bitcoin at the time of the transaction. The buyer must report the transaction as a capital gain based on the difference between the price paid for the Bitcoin and its value at the time of the transaction. This could get tricky. The record keeping for the taxes owed on cryptocurrency purchases could get onerous. Fractions of Bitcoins can be spent. A fraction of a Bitcoin can be as little as 1/100 millionth of a Bitcoin, which is known as a Satoshi. Each coin in the Ether virtual currency is equal to 1 quintillion Wei. For instance, if you buy a cup of coffee using a fraction of a Bitcoin, you owe taxes on the difference between that fraction of a Bitcoin at the time it was purchased and the time that it was used. Taxable events using cryptocurrency. Cryptocurrency brokers aren't required to issue 1099 forms to their clients, as stockbrokers currently do. However, Traders are supposed to disclose everything to the IRS or face tax evasion charges. Taxable events related to cryptocurrency include exchanging cryptocurrency for government-issued currency called fiat money, paying for goods or services such as using Bitcoin profits to buy a car, exchanging one cryptocurrency for another cryptocurrency, receiving mined or forked cryptocurrencies. The following are not taxable events according to the IRS: buying cryptocurrency with fiat money, donating cryptocurrency to a tax-exempt nonprofit or charity, making a gift of cryptocurrency to a third party, transferring cryptocurrency between wallets. Determining how much profit you've made and how much you owe in capital gains taxes is understandably complicated. Cashing out cryptocurrency. Just like with any asset, your taxable profits or losses on cryptocurrency are recorded as capital gains or capital losses. When exchanging cryptocurrency for fiat money like US dollars, the trader will need to know the cost basis of the virtual coin they're selling. For example, if you bought Bitcoin at $6,000 and sold it at $8,000 3 months later, you'll owe taxes on the $2,000 at the short-term capital gains tax. Profits on the sale of assets held for less than 1 year are taxable at the person's usual tax rate, as if the money was earned income. For the 2021 tax year, that's between 0% and 37%, depending on the taxpayer's income. If the same trade took place a year or more after the Bitcoin's purchase, you'll owe long-term capital gains taxes. Depending on your overall taxable income, that would be 0%, 15%, or 20%. And with that, we've reached the end of today's episode, all about crypto tax and how everything around it works. Do you invest in crypto? If so, which crypto? Get involved and let us know in the comments section down below. If you enjoyed this one and found it helpful, then leave a like and subscribe for more content just like this. Thank you for watching, and we'll see you in the next one.